let's do it then. So I'm going to go back to the adjusting tab, and it's just going to be on 3/1. All of our reversing entries are the day after the adjusting entry. So our adjusting entries, unlike normal, which would normally be 12/31, December 31st, ours were entered on 2/28, and then the next day is 3/1, unless there's a leap, whatever, unless it's a long year, 2/28, 2/29, you get the idea. All right, so where's the adjusting entry? Here's the adjusting entry, and then we're going to say, okay, this is going to be a reversing entry for unearned, I'll put this down here, revenue. And I'm just going to bring the same dollar amount. So obviously I'm just going to do the opposite of what we did here. It was 450, so I'm going to bring that down. So 450, I'm going to say then accounts receivable is going to go back down. What did we do with the adjusting entry? We increased the accounts receivable because it was understated, because it was showing payments from customers for which there was no invoice yet, because we got paid before the invoice. So now I'm going to put it back to where the accounting department had it, and we're going to say it's going to go back down. And then the other side is going to go into the unearned revenue. So note, like if I didn't do this reversing entry, I could just tell the accounting department, hey, look, just don't worry about that 450 in unearned revenue. We will adjust that again next time, next period, next year, or next month, or next quarter, whenever the next adjusting process is. But again, it's probably better just to reverse it so that they don't even have the question, right? So we could just put it back to where it was before, so they don't be like, what are you doing, man? What are you doing? All right, and so then we'll put some zeros across the board. Zeros across the board. Zeros across the board. It's kind of unfortunate, but you know that it's like in a construction site, when you have two different people working, you've got the framers and then you got the electricians and the whatever and so on. The next crew always blames the prior crew for any problems, right? That happens in any kind of business, right? So if the bookkeeper has a strong incentive to blame the to blame the person that did the taxes or the adjusting entry, sometimes that's not all, So you gotta try to make that communication as clear as possible, so that you don't end up in that situation. But in any case, so notice we put the 450 up here. So there it is, and we're gonna reverse it now. And so this is gonna be equal to the decrease, boom. So now we had this one and this one are going to tie out. Now note that normally if you saw this, you would think, oh, well, there's an increase. That should be like an invoice, and the decrease should be like a payment. And that normally would be true. But remember that if this was, and this only matters if you're in the software, because we're recording it basically with a journal entry. So you're seeing the bare bones of the transaction. But in software, you would use forms, which are data input forms, not necessarily forms you give to people, right? And so the form, so the fact that we're not using a form, or you can say that the journal entry is the form that we're going to use instead of an invoice and a payment, is why we put it into this new customer account, so that again, I can match those two out. It's going to look funny, but I should still be able to tie them out, hopefully, so they don't show as outstanding on reports, right? And so then this customer hopefully will just be hanging out at the bottom of the customer list, maybe even make it inactive, but it's not going to be having anything in it after we match everything out. It's kind of a clearing account for the customer. All right, I'm going to copy that down. So our balance is now at the 22,176. That should tie out to what's in the AR after we adjust this. This minus this is the 22,176. Let's put an underline across the board. Underline. We're going to go to the Home tab, Font Group, underline. Let's bring down the balance, baby. Bring down the balance, baby. then my assistant's like, don't call me baby. I'm not bringing down the balance if you call me baby. I'm like, dude, it sounds cool to say baby when you say balance baby. Balance baby. It's not like, no, okay, oh no, the human resources is on the email. I'm going to have, dude, it sounds cool, okay? That's the only reason I said it. It sounded cool. Bring down the balance, baby. That's not a reason, they say. That's not a reason for being crude like that. Dude, whatever. It is so a reason. If you want to sounding cool is important. No one wants to listen to you if you don't say cool stuff. They don't agree with that. I'm going to copy this down. You don't have to be cool in the accounting department. You have to be cool in the accounting department. It's important. You got to say stuff that has alliteration in it. Anyway. So we're back in balance. So notice again that this reversing entry is not something that is a classic adjusting and reversing entry, because we don't have the timing difference here, meaning there's no income statement account involved. And it would be involved if you had the classic book problem. But again, remember that the book problem gives you the theory of why you have a liability involved with the prepayment, but it's not actually giving you oftentimes what is the practical problem in real life, which is the subledger situation. So remember, what you want to do in practice then is always be thinking, is this a type of industry that's going to have this prepayment type of situation? Is it a subscription model? Is it a situation where they have customer deposits, like in a rental company or something like that? Or any kind of rental situation? And if it is, then make sure that you look in and say, well, how does this company deal with the prepayments? Is it being recorded as an unearned revenue when they get it, or is it a negative receivable? And whatever they're doing, or are they incorrectly accounting for the revenue when they get paid, and they're not properly on an accrual system? Is that going to be a problem for taxes? Maybe not, because in some cases the tax code would like to get paid. They would like their money when you get paid, right? So the fact that you record the revenue when you get the money might be what the tax code wants, of course, because they want to get paid sooner. So then that's another question you want to be thinking. It's like, okay, if these prepayments are involved, how do I have to report that for taxes versus accrual reporting and so on? And just take that into consideration, of course, when you're picking up new clients, because it is an added level of complexity. I've had clients, by the way, before I really understood this subledger situation, when I had more of book accounting knowledge, and it drove me crazy. That was like, what are these negative amounts in the accounts receivable? This doesn't make any sense. They did something wrong. There's a problem here. They messed up their bookkeeping. I didn't understand, and then it took me a while to kind of figure out what they're doing and why, So when we come out of if you come out of a school setting, or if you're working with someone that comes out of a debits and credits setting and not as experienced with working with software, for example, then you're going to have, again, the communication becomes important so that everyone knows what's going on.